Good morning, everybody. How is everybody doing this Monday morning? This is Live Market Open for Monday, January 18th. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street this morning. I hope you can hear me well and see on the screen. As usual, we'll talk about recent developments in markets, charts and levels, and of course the next 24 hours. Most important thing, as we had on Friday especially, but also on other days, is of course your questions. If you cannot see the chat box alongside the video, please go to the address on the screen, tlk.io/fxstreet-forex-live-video. Okay. So, what did we have in markets on Friday? Friday was certainly busy. The focus was on US figures. We had disappointing retail sales from the United States, especially from the control group. They added worries to markets that things are not going so well, not in the US, not in the global economy. It was not all the figures were terrible there, but the control group was weak and we didn't see any acceleration in growth, okay? Industrial output in the United States, like in the UK, like in China, like everywhere else, looks weak. Okay, this added a bit. And then we had an okay consumer confidence figure from the University of Michigan. It came out a bit above expectations, but it wasn't enough to change the picture for global markets. Okay, what we had on Friday was a further sell-off, further fall in oil prices. The consolidated oil prices under $30. We also had stock markets fall in the United States, and that sort of extended all the trends that we've seen beforehand. That were, of course, second. Okay. Yeah, all the trends that we've seen beforehand. For example, a weaker pound, the pound fell further, euro strengthened, the yen strengthened, safe haven currencies, and commodity currencies went up. Okay? No, I can't remove this. Oh, okay, here it's gone. Okay, so that's what we had on Friday. Towards the end of the day, towards the end of the trade, we did have some kind of last-minute reversal. All right? It was some kind of profit taking, but in general the picture remained gloomy. Okay, so let's look at a few things we had over there. For instance, euro dollar made its way, got close to 110, close but no cigars. They said it crossed the 109.80, but then fell a bit. This morning it's extending its falls, still very much within the range. Okay, but we're waiting the ECB this week. All in all, we're still in the range, battling with just under 109 at the moment. 108 provides support, followed by 107.10. The euro remains a safe haven currency, but this week it's a bit more vulnerable just because of the ECB. All right, dollar yen, same picture here. It fell under 117 on this disappointing retail sales release, disappointing more worries about the global economy, unwillingness of the Fed, if you wish, to change course. So we had a more flight to safety, a stronger yen. On Friday, also we had an extension of the fall in the pound, and this time it wasn't accompanied by this. We cannot see here a bounce. Okay, cannot see some kind of small correction as we've seen in euro dollar or dollar yen. It's very, very weak. Current support is 142.50. All right, which is the lowest level since 2010. Really unconvincing news for for Britain last week. We had the manufacturing production, industrial output all fall, and this sort of, if you look at the range, it doesn't look good for the pound at all. Okay, so we had also new lows in pound yen and new highs in euro pound. That means the pound is falling across the board. The pound is joining commodity currencies. The number one commodity currency of them all, of course related to oil prices, is the Canadian dollar. Dollar CAD extending its highs. Can point to some kind of support here at 144. But we've reached a new high of even 146 over the weekend. What happened during the weekend? I guess you all heard the news that Iran came back online. Okay, the IAEA, the International Atomic Energy Association, I hope I'm not butchering the initials. Anyway, they declared that Iran fulfilled its part in the deal. That means that sanctions could be lifted immediately. The European Union announced that it's beginning the process of removing the sanctions, and also the United States removed the sanctions. There was also some kind of prisoner release. So not all sanctions are removed, but the most important ones, well, Iran is back into international trade, into the SWIFT system, and for us, this just adds pressure on oil. Of course, this was very much expected. We got lots of hints about that when everybody knew it's going to come in January. And we also got the hints that it was expected to come back online. I mean, that sanctions are expected to be lifted on Monday. Nevertheless, if we look at oil prices, it just adds to the pressure, all right? So we're still lower on the day, okay, 2.7% down on WTI crude oil, even though we had a big crash on Friday, and this is the fresh crash from this morning. 28.35 was the low, and now we're a bit higher. As I said, it was the fall in oil prices and perhaps the extension of the lows in CAD and AUD and other currencies was exacerbated by a low volume on the Asian session and the wake. Now we have some kind of stabilization, we have some kind of correction, but oil is still lower than on Friday, and it doesn't look good. There's just too much supply and not enough demand. Okay, so dollar CAD 146.05 is the new high, currently back to 145.25, but all in all, the trend is quite clear. All right, Aussie dollar also reached new lows. It began on Friday. It fell under 69 with this global gloom and doom. Now we're fighting 69. During this low liquidity crash in the Asian session, we reached a new low of 69.34. These are the lowest levels since 2009. Let me just verify that. Yeah, have to go a long way back. Maybe the monthly chart is much better. Yeah, here we go. Yeah, since April 2009, nearly 7 years, the Aussie is at these post-crisis extreme lows. Okay, of course, for us, for the Australian dollar, the biggest worry is China, China, and China. Tomorrow, we have the Chinese GDP release. Extremely important, of course, and we'll see how that goes. Of course, China is expected to report 6.9% growth rate. Annualized, nobody will believe it anyway, and the worries will persist, but so people will also look at industrial output, fixed investment, and things like that. Okay, we'll talk about that later on. So also the Kiwi dollar, which is doing better than the Australian dollar, and the economy is doing better. It also suffered this sell-off on Friday, and did manage to recover, at least in the last hours on Friday, and then today once again it began on lower ground, just above 64, and since then it's been recovering, because really the economy in New Zealand is not that bad, and when things stabilize in markets, the Kiwi does have an opportunity to rise. No rate cut is expected in New Zealand, and nothing extreme is going on there, so we are expecting some better situation. Okay, dollar Swiss around parity once again, but there's intervention here by the Swiss National Bank. Around Euro Swiss, we've seen Euro Swiss move a bit higher, so it's settling on higher ground. This SNB said that they will intervene, and also they said that they want a weaker franc. We've seen this weakening. It happened a few days before the anniversary, the 1-year anniversary of the SN bomb. I think they're also trying to mitigate potential action from the ECB. Why am I saying that? Because this is what we've seen last year. But this time we're not expecting any extreme action from the ECB, but we are expecting some kind of. But the ECB could push the euro lower, so the SNB is there waiting. Now I mentioned euro pound reaching new highs at 76. Yeah, it even touched 77, but now it's a bit, it has calmed down. It's falling lower, but still 76 supports the pair, and we're still keeping a safe distance from this level. Okay, so it's the weakness of the pound more than the strength of the euro. Euro yen, you can see here it's a bit lower. It was hugging the 128 level, but very much in range between 127 and 129. Now it's a bit lower within the range, but these currencies are both safe haven currencies. This means that they're not, that they both trade more or less in tandem. Bad news, falling stock markets. Both rise against the dollar and against everybody else. Good news, they slide against everybody else, okay? But they do it most of the time together. This could change this week. Okay, pound yen, the Gepi, the dragon, a very, very clear trend to the downside, 167.53. This morning it's making some kind of a recovery, all right, because there is some kind of profit taking, some calming down, some movement up from the lows in commodity currencies, in oil. Here it's more some kind of sell-off of the yen more than a buy of the pound. All right. Yeah. So I think we talked about many currency pairs. Just take a look at. I'm talking about stock markets a lot, so let's just have a quick look at the big picture in stocks. We're back to the lows seen in well, a few months ago here in August. We're close to the previous Chinese stock market crash, but still above levels seen here in April. We did have a dip, I think, on Friday. Anyway, the S&P 500 moves alongside, and currencies move alongside the S&P 500 during the US session. So we have to watch out for that. But today is a holiday in the United States. So does anybody have any questions? We'll move to the events that we're expecting today, which are very, very, very few. So we talked about further stock and commodity route that we've seen on Friday. Today we have some kind of stabilization. The Chinese stock market closed marginally higher. The Chinese yuan was stable. In the past few days, the Chinese authorities are doing great efforts to stabilize the yuan, to calm down markets, to prevent a capital outflow, okay, to say that everything is under control. Okay, let's move to basically no events today. It's a US holiday. Okay, it's Martin Luther King Day. So not a very important holiday in terms of everybody's at home with their families, but the kind of holiday, the bank holiday that the markets are closed. Okay, and now before we talk about Chinese GDP, Kiwi dairy prices are lower in the last month, down 12%. The next auction will be weak. TDS said this week New Zealand dollar is weak, and fundamental report coming out. In New Zealand, we have this week quite a few things. Let's see if I have it on the main events here. No. Let's. So for New Zealand, milk prices did fall quite a bit. Yeah, that's true. But they did stabilize a bit. I mean, we had these long streaks. One was 10 weeks long, 10 auctions long. That means about 4 months of falls in oil, in milk prices, and then we had another fall. But since then, we had some kind of stabilization. In addition, in New Zealand, we had the RBNZ in their last rate cut. They said that basically they're done. They reached their historic low of 2.5%, and from there they said, okay, you know what? That's enough. We're not moving any further down. So that was sort of that paused everything, that provided some stability for the New Zealand dollar. Now, yeah, A weaker New Zealand dollar depends on bad data from China, even though New Zealand depends a bit less on China than Australia, because there is more stable and strong demand for dairy products compared to iron ore and copper, which is used in industry. So we need bad news from China to weaken the Kiwi dollar. But if we have some kind of stability in the markets, we could have the Kiwi recover, because as I see it, it sold off a bit too much. Okay, so regarding fundamentals reports coming out, I think we have a milk auction this week. Of course, we have it once every 2 weeks. This is the FX Street calendar on Forex Crunch. Let me just refresh it, and I think we have additional important figures in New Zealand after, well, a slow start in terms of indicators. Yeah, why can't... Yeah, okay. Here we go. So in New Zealand we have business confidence later today at 11 p.m. GMT. That's 10 here in Barcelona in the old continent, 11 GMT, 11 in the UK. It's a quarterly figure, not that important. Last time it fell 14%. I don't have a consensus for this one. Could have some impact. The bigger impact for the Kiwi, for the Aussie, for CAD, for the Euro, for everybody, comes from these figures, okay? For the Chinese figures, let's see if you have anything else in New Zealand. Yes, right here. Yeah, remember there was an important event for the Kiwi, which is not expected to affect other markets, but it is important if you trade the Kiwi. It's the Consumer Price Index, CPI, expected on what day is that? That's tomorrow evening, okay? And we're expecting here a fall of, a rise of 0.4% year over year. No, sorry, that's the consensus. Yeah, no, that was last time 0.4 year over year, and this time, and last time also 0.3 month over month. I don't have here a consensus for this week. It's a busy day this Tuesday. We also have the milk auction on the same day. There's no fixed hour for the milk auction, but usually it's around 4 or 5 GMT, something like that, sometimes 3 GMT. Last time we had a drop of 1.6, but we did have some kind of stabilization. The losing streak I was talking about came here, okay, between March more or less and the end of the summer, well, winter in New Zealand, till August, and then we had a few consecutive rises, a few falls, and recently the moves are a bit more shallow, okay? My system's gone down just as you were mentioning the Kiwi. Oh, sorry, I was trying to answer your question. In general, I see that the New Zealand economy is relatively robust. Milk prices were down, but did manage to stabilize. The RBNZ talked about not cutting rates further, but a lot depends on the mood in China. Now let's go back to China for those, because that's the big event. Not today for those of us in Europe, but overnight. So let's talk about the headline event, the one that is expected to move markets most, even though nobody believes it. Okay, so this is Chinese growth year over year. We had China growing 6.9% year over year last time, and now it's expected to rise only 6.8%. Now, nobody really believes anything coming out of official China, because it's not a democratic regime, because the party has political interests, because the data is compiled very early in the quarter. There's only one release, no revisions. Okay, in other countries we do have revisions. In China it's one and done and released very early. Okay, and the government always has a target for growth, and they more or less meet the target. Okay, so in the past there were different ways to measure Chinese GDP. They still exist. Okay, the amount of cargo on rail and on ships, electricity used, and other things that can be measured in a more accurate way, okay? But things are becoming a bit different. Why is that? Because China is trying to move from manufacturing and investment, being the factory of the world, more or less, okay, to more services, providing services, like its rival India, and like what's happening in the developed world, and consumption, internal consumption. This move is happening, but it's happening very slowly, and it's much harder to measure services from the outside, because if it's not easily measured like electricity for a factory. All right. No matter what figure is coming out tonight out of China, nobody's going to believe it. It's going to be, of course, from China that they're going to show everything is okay. I believe we'll then see some kind of positive reaction, a strengthening of the Aussie, a strengthening of other commodity currencies, a weakening of the euro and the yen. But this could be very temporary because doubt will creep in. Now, in order to mitigate all these doubts, we have other figures that maybe they could steal the show, okay? So, well, that's quarter over quarter, but perhaps industrial output. Industrial output has a clearer graph here. It leans more to the downside than GDP. It's expected to drop from an annual level of 6.2 to 6%. And that's more of a concern for Australia, because Australia needs this industrial output to continue growing. But for the rest of the world, we could perhaps have more of a focus on retail sales. Retail sales, as you can see in this chart, they're actually going up at the year-over-year rates. This is more related to consumption. This is practically consumption, services, and that's what's going on. Yeah, China is the second largest economy in the world. Would you consider it unstable? No, I think they're relatively stable. The problem is China carried the world since 2008, 2009. They decided to confront the crisis. And confronting it means that they made two ways of investment. First of all, massive infrastructure investment, lots of money coming from the government into the economy. And they also unleashed a private credit bubble, enabling banks to lend out more money. That created lots of growth, but some of it very unproductive. And since then, sort of China picked up the baton from the rest of the world, but Europe just got into trouble. The United States did bounce back and recover, but this recovery is slow, and China just can't go at it alone. And now when commodity prices are falling, China is also slowing down. It's not about to collapse. They still have a lot of reserves. They still have a government which is incapable of managing the stock market. Yeah, that's true. But they are capable of, I think they're capable of stabilizing things. Other countries will also have to do their share. You can't rely on Chinese demand. Germany, for example, enjoyed lots of growth because of Chinese demand for its products. Also, the other countries in the world have to pull themselves together. Okay, so, but I don't think China is unstable. It just cannot work on its own. Okay, so this is a very important release, not only for the Australian dollar, but also because of China's growing importance for the world. China's growing importance for currency trading, because when we have a fall in the Chinese stock markets, we have this risk-off reaction: stronger euro, stronger yen, weaker everything else. Okay. Another thing that is related, this is the CME Group Fed Watch. This is the implied probability of a rate hike in March. Okay. So, well, first of all, let's get January out of the way. 90% no second rate hike in January. But look at what happened here. Okay. Because of Friday's weak figures from the United States, we have a lower chance of a rate hike in March. Now it's 70%, nearly 70% against a rate hike. Okay, so this in theory should weaken the US dollar, and it did weaken the US dollar against the euro and the yen, but it did strengthen against the others. Now a rate hike in theory was supposed to strengthen the US dollar against everybody else, and no hike to weaken it. But the reason for probabilities to have fallen is because there are worries that also the United States isn't doing as well. Some talk about an outright recession in the United States. The economy is contracting. It does look like this in manufacturing, but manufacturing is only a small sector of the economy. Okay, let me see what else I want to talk about. Any more questions? Basically a quiet day. That means in the European morning we do have action, but then it's the US holiday, we'll have quiet. And for those of you that are awake at night, we have yeah, we have the Chinese GDP. How can Chinese GDP impact euro dollar? Well, the formula in theory is quite simple. Okay, let's look at euro dollar. Euro dollar is stuck in range for quite some time. I don't see here any trend to the upside or to the downside. This week we could have more pressure from the ECB, but at the moment we're very much in range. Okay, this shoot higher here is what Draghi did last time, early December. Since then, a bit higher, a bit lower, stabilizing. Okay, the euro turned into a safe haven currency. That means bad news from China, or if markets interpret the news from China as unreliable or bad news, which could be the case, we could see euro dollar going up. Okay, if markets do believe that China is not so bad, and I mean the growth is still strong, then of course we could see euro dollar fall down because there's no need for risk. But this week is a bit different. This week on Thursday, in just 3 days' time, one of the more exciting events in Forex trading is the ECB rate decision and the press conference by Mario Draghi. We'll do a full preview on Thursday, of course, but basically Draghi and some of his dovish colleagues want to do more. A weaker euro, more support to the economy, looser credit conditions to get growth stronger. But the hawks, especially the Germans, don't want further printing of money. And in general, I think all of them agree that governments should do more. Nothing is expected from the ECB this week, but they might hint of action in March. Okay. So far, if the ECB is data-dependent, data for relevant to the ECB, inflation has been poor. Okay, worse than expected, and those are the figures from December. Since then, we had another fall in oil prices, and the mandate of the ECB is headline inflation. That means including oil. In addition, contrary to the United States, the ECB sees oil as not as transitory, but as falling oil prices could turn into a deflationary mindset, and the ECB might opt to mitigate that. Okay, so we could have more of a muted reaction from euro dollar on Chinese GDP. We could have a stronger reaction from the other safe haven, from the Japanese yen. The biggest reaction from Chinese GDP is, of course, the Australian dollar. China is Australia's #1 trade partner. Okay, we have more questions here. Can the pound fall further? It can always fall further, but I see it, well, first of all, as we speak, it's bouncing back up. All right, more of this kind of risk-on atmosphere, not risk-on, but let's say some kind of profit-taking. So the pound is higher on the day, but look how low it has already reached. So it's rising today. Well, from the lows, it's 80 pips. Nice volatility in markets. My line in the sand for my support line is 142. Sorry. Why am I saying 142? Because this was support back here in 2009 at the oh, sorry, a bit confused, too many lines in the charts. Sorry, that's the line from 2010. Okay, to be precise, May 2010 we had around these levels was 142 142.25, but yeah, I would say markets are looking at the round number of 142. And then, of course, much lower is 135, which was the lowest level for many years, the post-crisis low seen in January 2001. Okay, the pound can fall further, of course, but the move, if we look at the daily chart, look how many consecutive days of falls until we've seen this kind of bounce today, which is still unclear if we do have this kind of bounce. The fall in the pound is a bit stretched. On one hand, on the other hand, we did have a losing streak of economic indicators from the UK. So it's the Bank of England still voted 8-1 and not 9-0 to Yeah, nice blue chart, thanks. The Bank of England did vote 8-1, still one member voting for a rate hike, still looking for developments in oil prices, so it's not all terrible. Maybe we could see another bounce. A lot depends on the mood in markets. Okay. Now we have important figures this week: inflation and employment from the UK tomorrow and Wednesday. So yeah. Another question here. What movements of euro dollar you expect until the ECB rate decision? What boundaries of the range? I would expect very limited moves, especially today, tomorrow, and Wednesday. Perhaps Thursday, just before the release, we'll have more jitters in markets. Okay, but basically the range, the narrow range is 108 to 109. The wider range, if we have bigger moves, is 107.10 to 110. Okay, but I don't see the pair moving beyond those levels unless we have a surprisingly terrible report from China, and they'll admit that the economy is in trouble, and that could send euro dollar higher, or if we have some kind of leaks from the ECB saying they're about to announce further measures, and this could hurt the pound the euro really badly. Okay. But I want to say one more thing about euro dollar and oil. The euro is a safe haven, right? So in times of trouble, money is repatriated home, and the ECB prints a lot of money, has a negative deposit rate. Money flows out of the eurozone to look for riskier assets, especially emerging markets. In times of trouble, money is repatriated home. We've seen this phenomenon with the yen for a very long time. Okay? I mean, I've talked about it many times. That's the short version. Now, when oil is falling, it's a sign for markets. It goes hand in hand with falls in stocks, with weaker demand, with trouble for the world, and that's what strengthens the euro. The fall that we have in oil prices today is related not to demand, because we didn't have fresh news from China, but to supply. Okay, Iran has been relieved of the sanctions with the nuclear deal, so it's expected to send out around 500,000 barrels of oil per day, and perhaps even more. It has already customers lining up, so there's going to be more oil in international markets. So it's the fall in oil prices today is more related to supply. Yes, it's not news. We all knew that the sanctions are going to be lifted. We had all the possible hints from Iran, from the EU, from the United States, but it's finally happened. Supply is higher. It doesn't mean that demand is lower, not lower than we knew at least. So the recent fall in oil prices does not go hand in hand with a stronger euro. But of course, if we have news from China, good news, it means stronger oil, weaker euro. Bad news, weaker oil and a stronger euro. Okay, so that's a point I just want to make about oil. For the Canadian dollar, this doesn't matter, of course. Well, we're seeing some kind of a correction here after we reached 146, so we're now full cent down on dollar CAD, but basically the Canadian dollar trades in tandem with oil prices. What makes the yen such a great safe haven? Why do investors go there when there is trouble? Is it their deposit rate, their economy, origami, sushi, and top nuts, and why more than anybody else? Well, yeah, sushi is great. I love sushi. Not so good at origami. Anyway, but what makes the yen such a safe haven? Okay, why did the yen strengthen in recent weeks like it did, falling off that range and further deepening and falling lower? So the Japanese yen, for many years, the interest rate there was extremely low. Okay, it's not a new phenomenon that happened after the financial crisis, but it happened for a very long time. There was a boom and bust in the late 80s, early 90s, and then they lowered interest rates. The economy never recovered. Japanese are in this deflationary mindset. Stock markets didn't recover. Doesn't mean life is bad in Japan. Yeah, okay. GDP growth is low the last decade, the second last decade. Stock markets are low, but unemployment rate is also low, and the standard of living in Japan is still very, very high. Anyway, for long time interest rates were low, and they still are. So money was lent in Japanese yens and went to riskier assets abroad. In currency markets, one of those trades was the famous carry trade, was lending in yen, buying Australian dollars that provided an interest rate of 5 or 6%, or buying Kiwi dollars, which offered 8.75 at the peak, okay? Now, these interest rates are unimaginable in the developed world after the crisis, but that's how it was. Of course, you just had to sit on Aussie against the yen or Kiwi against the yen and wait, and the interest rate would just pile up. And this was true as long as interest rates remained high and the exchange rate didn't move. And of course, with the financial crisis, the money was repatriated to Japan away from riskier assets. The exchange rate collapsed, and this became unsafe. Now, also after the crisis, we've seen that the best example was the tragedy of March 2011. We're near the 5-year anniversary to the 9 Richter scale magnitude earthquake, the tsunami, and the nuclear disaster in Fukushima that followed. And what happened after this terrible news from Japan that killed so many people and hurt the economy quite a bit is that money came home to Japan once again. The yen strengthened. It strengthened so much. There was this rare event of coordination between central banks to weaken the Japanese yen, to try to help the Japanese economy as an act of solidarity with the Japanese people. Okay? So the yen is this kind of safe haven. Now, maybe the better term for safe haven is a funding currency, because the yen and the euro are used, they're cheap, interest rates are low, and they're used to fund other currencies, okay? To fund other buys of riskier assets. So that may be a better term. But in financial news, you see everywhere a safe haven, okay? Two phenomena. When things are bad, we see flight to safety, risk off, risk aversion, safe haven currencies. These are the terms. And when things are better, you see risk on, risk appetite, and yeah, or selling havens or whatever. Okay, these are the terms. That's why I'm using them as well. Okay. This is what's going on with the yen. Any more questions? Right, the big event we'll talk about tomorrow morning is Japanese GDP, but also the other figures like industrial output and fixed asset investment and retail sales and everything over there. We also have UK inflation data I mentioned on Tuesday, and then employment data, inflation data in the US, which is more important because of the Fed's focus on inflation, rate decision in Canada in which they could cut oil inventories. On Thursday, the Draghi show, and winding down on Friday with other events. More questions here. With Japan being an export country and depending on income from export, their fundamentals will come back weak, which could reverse the trend. When will people put their money? Japan, yeah, has income from exports, electronic goods, cars, lots of high-tech stuff from Japan, very rich and developed country. It needs a weaker yen to export, and in the past it needed a not that weak yen because it relies on energy imports. After the Fukushima disaster, they had to buy more oil because they closed a few reactors. But your question is, I think in general they're comfortable with the current levels of dollar yen. 115 to 125 is comfortable enough not to anger their neighbors with the yen that is too weak, but the yen is weak enough for exports. Question regarding anything that can move euro dollar today. I think the moves could be limited because of tension towards the ECB and because of the US holiday. But remember that the ECB is very, very talkative. 23 members in the governing council. They all have press contacts, and we could have some hints, reports on Reuters, on MNI. These are the strongest ones regarding reports on the ECB, saying that the ECB will do that or will do the other thing. Some of these reports could be false, but it doesn't mean that they don't move markets. So I would say that reports from the ECB could move markets. We also have some very, very minor publications today. Yeah, we have Italian trade balance. I don't think it ever rocks the boat. So that's just after the show. Anyway, and in the United States we have nothing. So it's oil prices as they move after the Iran sanctions. It's, well, here in Spain we still have this political deadlock, and I'm following a bit the Spanish press. Basically lots of blah blah and nothing really happening. It's unclear if we'll have a right-wing grand coalition, I mean led by the right, or a left-wing coalition, or new elections. An opinion poll released this weekend in Spain showed most Spaniards don't want new elections, and most of them would also vote in the same way they did in the previous elections, with very minor changes. So anyway, it became more interesting, but so far it didn't move the euro too much. So I would say ECB rumors, and ECB rumors. That's what can move markets today. And then, of course, Chinese GDP, but that's in the middle of the night. Okay, so it's time for the wrap-up for today. This is the wrap-up for the live market open on January 18th, 2016. Still a relatively gloomy mood in markets. On Friday, it was terrible, with disappointing U.S. retail sales that sort of triggered fears of recession, and there were lower chances of rate hike in the United States because of weaker economy. Also, industrial figures were terrible, and only consumer confidence was okay. We had a further stock sell-off and a commodity rout, with oil prices settling well below $30. Another shock to oil prices came from, well, it wasn't that shocking that Iran sanctions were lifted as part of the nuclear deal. This morning we're seeing some kind of correction, but it's, oh, I can't see the screen, sorry. Here we go. Some kind of a correction. We're seeing that means safe haven currencies are a bit weaker. Euro dollar is within range, 108 to 109. Dollar yen a bit higher, 117.32, just above 117. It dipped below this level last week and reached 117.50 more or less. 118.20, or sorry, 118.30 is resistance on the top side. Pound dollar also came late to the recovery game, and I see it as yet another dead cat bounce after falling to 142.50, just below this level. Pound was hit last week by weak figures, and it trades like a commodity currency. Weak stock markets mean a weaker pound. Currently recovering to 143.07. I put a resistance here at 143.50, more or less. That was a low point that we've seen beforehand. Okay. Dollar CAD, of course, moving higher, weaker Canadian dollar because of weaker oil prices. Again, some kind of a correction. 146.05 was the low, but the high, sorry, but that was on thin liquidity. And yeah, big week for Canada with the rate decision as well. Australian dollar awaiting Chinese GDP, struggling at low ground, fell under 69 last week to the lowest levels since 2009. With this early sell-off in the Asian session, it fell to a new low of 68.34. Currently some stabilization, holding its breath basically to the Chinese GDP. Kiwi dollar got carried away with other commodity currencies, but it's recovering. The situation there is better. Okay, we have tomorrow we have the milk prices and other figures, CPI. Yeah, so that's it for events today. In terms of indicators, it's a very, very quiet day. Basically, we don't have anything in Europe, and it's a US holiday today. That means currencies continue trading, but volume is low. Big event and the tension today is towards the Chinese GDP, the first and final release for Q4 2015, and basically the final GDP for the whole year. Expected to stand at 6.8. Nobody's going to believe it anyway. Industrial output, fixed asset investment, retail sales are all closely watched to see where the Chinese economy is doing, because China, second largest economy in the world, is the global engine of growth, has been so. The United States is not picking up the baton so fast. Europe is still the sick man of the world. So a lot of eyes are towards China, not because of the stock market, but more because of the strength of the economy. Okay, so that's the big event. Before we head off, I see here more questions. What about German Harmonized Index of Consumer Prices tomorrow morning? That's the HACP. It's the final release. That's why I didn't mention it, and it rarely changes. Okay, so we had a very disappointing initial release. That's at 7 GMT, an hour before the show. We're expecting a confirmation of the year-over-year 0.3 in the national figure and 0.2 in the harmonized one, which is the EU standard. No changes. It's very rare to see changes in the final German CPI read. If we'll have any change to the upside or to the downside, it can impact, of course, the euro in a straightforward manner, but usually it's extremely rare to see a change there. Possible, can you focus and discuss pound kiwi? Yeah, pound kiwi is both are currently the risk currencies selling together. Let's see if we have this chart. No, let's look for the chart. On the screen. Oh, here we go. So currently 221.30. It fell from the highs, but the trend, I think, is, I'm looking here at the hourly chart. We've seen some bottoming out at the turn of the year, right? We've seen some bottoming out here at these kind of, in this blue area, if you wish, 215. And since then, we're seeing some kind of rise. Yeah, because the Kiwi dollar took its time with joining the rout. At first, it was relatively strong. Then it went up. In recent days, the fall of the pound, which has accelerated, has pushed the pair a bit lower. Let's look at a few levels here, if you wish. This pair doesn't reflect the divergence between safe haven and risk currencies, because both are risk currencies. Okay. Anyway, the levels that I see here, 224.75 or 225 if you wish, 223.10 more or less, but it's unclear. It's a bit more choppy, and around current levels, perhaps strong. I see a strong line here at 219. And further, maybe this one here. A recent low here at 220, more or less, 220.50. These are the lines that I see for this pair. I don't have a clear, well, I think the Kiwi is a bit stronger than the pound. It means we could see further falls, but both, if we have bad news from China, both currencies are going to fall more or less together. Okay, so the moves are not that strong. Let's just take a peek at the daily chart. Daily chart, we've seen a huge rise all the way into August. In August, we had the crash of the Chinese stock market. Yeah, but the Kiwi was relatively strong. I see a bit more pressure to the downside in terms of fundamentals, but it's not a pair that has sort of a clear bias and lots of pips, contrary to, let's say, Kiwi yen or pound yen or euro Kiwi or euro pound or things like that. Okay, we hope that answers the question. Thank you very much, everybody, for coming today, for asking those great questions. We'll be here as usual tomorrow. I wish everybody a safe and successful trading day. And that's it. Thank you. And just last more question. Yeah, Euro Kiwi. It's a much better trade. I'll have one look at that before I head off into the sunset. Yeah, here we have, I think, slightly more significant moves. Well, not today. Today isn't the best day, but this is more of a risk pair. Okay, we reached highs here at 170, just above 171, and 171.44. Now we're sliding back down. Bad news from China, and this pair can resume its rise. Good news from China, the pair falls. Okay, anyway, have to go. Thank you very much. Wish everybody success today, and see you tomorrow. Thank you, and bye-bye.